Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is Fergus Hodgson with the Gold Newsletter Podcast. We are rolling with Peter Schiff, and I also have Brian London, my co-host, on in New Orleans. Peter Schiff is the CEO and Chief International Analyst with Europac. He also runs Schiff Gold, which is just schiffgold.com. His latest book, The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. And he's also a speaker at the New Orleans Investment Conference, which is neworleansconference.com. We have a special running for this episode. Just enter the promo code Schiff, that's SCHIFF, and you'll get upgraded from a regular attendance to a gold club. So the discount code is his last name, Schiff, SCHIFF. Peter, welcome back to the Gold Newsletter Podcast.
Oh, well, thanks for having me on again. Of course, Europac stands for Euro-Pacific Capital, which is the broker-dealer that I am now affiliated with. And, we have Euro-Pacific Asset Management, which is my asset management company, which is now located here in Puerto Rico.
Okay, so you were famous for your appearance at last year's New Orleans conference. The event was the Booms, Busts, and Bubbles panel. And we just sent it out to followers for people to chew on. And at that time, all three members of the panel suspected, and this is about 8 months ago, suspected that the U.S. would enter a recession within the next year or two. How long do we have? Do you have a sense for how long the United States has before the bubble will pop that you've been writing about for so long?
Well, it's long overdue. That's the thing with bubbles. You never really know how big they're going to get. I think the one that we have now is the biggest in history. So it's already, beyond the point where it should have popped. But there's no way to tell. But I still think that forecast of a recession within the next year or two is going to end up being accurate. I mean, whether it's closer to 1 or 2, it's hard to say. We did get that 3.2% number for the first quarter of this year, which I do think is a bit of an aberration. Part of it had to do with a very low deflator, which really, you look at it initially, it wouldn't make any sense because we had a huge run-up in oil prices in the first quarter. But I think that was a result of the big drop we had in the prior quarter, and somehow the government pulled that forward. So we're not going to have that tailwind in Q2. In fact, it's going to be a pretty high bar that the GDP is going to have with a very, very big deflator, I think. And then you had to run up in inventories. You had some help from a smaller trade deficit that I think was related to the higher deficit from the prior quarter. I think companies were trying to front run tariffs. So I think we're going to get a much lower number in the second quarter, but we certainly could slip into recession. If you look at a lot of the other economic data that's coming out, the auto sales numbers that came out today were very weak. We've been getting very weak numbers in housing, and I expect that to continue. And at some point, the economy is going into recession, and that's going to be the popping of the bubble, because when we go back to recession, the Fed's going to go back to QE. The Fed's going to go back to 0% interest rates. And the reason that we didn't have a dollar crisis the last time the Fed did that was because the Fed convinced everybody that not only was the policy going to work, but that they were going to be able to successfully unwind it. They were going to normalize interest rates. They were going to return the balance sheet to pre-crisis levels. And the markets believed this. And I knew it was impossible, but that didn't stop the markets from embracing the idea. And they bid the dollar up and they sold off gold. But I think that the next time when we have to go back to QE, nobody is going to believe it's temporary. Nobody is going to believe the Fed is going to be able to unwind the balance sheet. If they couldn't shrink a $4.5 trillion balance sheet, they're not going to shrink a $10 trillion balance sheet. If they couldn't normalize interest rates based on the amount of debt we have now, they're never going to be able to normalize interest rates in the future when everybody has even more debt.
Brian here, your view that the Fed is going to have to actually begin cutting rates soon was a lot more popular a couple of days ago than it is today, because the Fed meeting, Powell came out and basically talked glowingly about the U.S. economy. And as a result, we saw the stock market sell off. We saw gold take a big hit. And now it just seems like we're back on autopilot, and there's no indication from the Fed that we're going to be cutting, or they're going to be cutting rates anytime soon. So to me, that just seems like everything is dependent. All of these markets are just dependent on what the Fed is going to do.
The entire rally that we just had was based on the Fed doing the about face and calling off future rate hikes. But I've always said that that was not enough, that we needed rate cuts. And now that the Fed seems to have taken the cuts off the table, at least in the eyes of the speculators, maybe that rally is over and we're headed back to new lows. And the market's going to have to call the Fed's bluff because they're going to be cutting rates. But, you know, the Fed is looking at these inflation numbers that are below the supposed 2% target. Now, there's nothing wrong with inflation being less than 2%. In fact, there's nothing wrong with prices falling. In fact, falling prices are better than stable prices, and stable prices are better than prices that go up 2% a year. But the Fed wants to pretend that we need the cost of living to rise by 2% a year. But they said, or what was said yesterday by Powell in the press conference, is that he thinks that this inflation below 2% is transitory, and so he's not worried about it staying below. He thinks it's going to go back to 2%, and so we don't need to cut rates in order to force inflation back up to 2%. It's going to go there on its own. And I agree with him about that. This is transitory, but where I disagree is that it's going to stop at 2%. I think that inflation, even the way the government measures it, which is highly inaccurate and it underestimates it, but I think we're going to go 2.5, 3, 3.5, 4, 5. I mean, I don't think there's a ceiling on how high inflation is going. And I don't think the Fed's going to do anything about it because I think not only are we going to have inflation, but I think the economy is going to be going into recession at the same time. It is going to be stagflation. And I think when the Fed is confronted with a choice of fighting inflation or fighting recession, they will fight recession. And that means creating even more inflation.
You know, one of the things I've been talking about in the whole newsletter, and the fact that the debt is so large now. You know, we had this era of zero interest rate policy, even negative interest rate policy. And one of the outgrowths of that, one of the things that did was encourage more and more debt creation, which we went ahead and did in the U.S. And now the federal debt over $22 trillion is so large that even minuscule increases in the interest rate create huge leverage and huge fiscal burdens for debt service. That is large. So that alone prevents the Fed from getting anything over really even a 3% Fed funds rate. At that point, the debt service costs rise to such an extent that we're talking about close to $1 trillion annually.
I mean, and that's before we get a big surge in rates. But also remember, wait till we get the next recession. I mean, because recessions are where the budget deficits really go up. What is supposed to happen is when you have a strong economy, you're supposed to pay down the debt. I mean, the government is supposed to run surpluses. That was the old Keynesian playbook, is you stimulate the economy with deficits in bad times, and then you pay off the debt in good times with surpluses. Now, what we've been doing recently is we've been running big deficits during recessions and then smaller deficits during recoveries, but we never stop adding to the debt. But what's unique now is we're running even bigger deficits during the recovery than we did in the prior recession. And so the next recession is going to be off the charts. We're going to be running $2 to $3 trillion a year deficits. I mean, that means you're talking about increasing the national debt by almost $10 trillion every 3 years. Right? I mean, and you can't even look at the official budget deficit numbers because that's just the tip of the iceberg. So much of what the government now spends is off budget. And if they borrow money to finance an off-budget expenditure, they don't even count it in the official budget deficit numbers. So what you really have to look at is not what the government reports as the deficit, but you have to actually watch the national debt. Watch how fast that number goes up because it's the increase in the national debt. That's the problem. Right? We actually have to borrow the money that's off budget. The markets don't care. Our creditors don't care if the money we borrowed was on or off budget. We still borrowed it. We still have to repay it back. We still have to service it. So the next recession is going to take the deficits to a whole new level. You know, that's why these guys are starting to talk about this nonsense about modern monetary theory, that it doesn't matter how big the deficits are. We can just keep printing money, and so there's nothing to worry about.
You know, just to put some numbers to what you just said, the deficit in 2018 was somewhere over $700 billion, but the debt grew in fiscal 2018 by $1.2 trillion. And it added $1 trillion of that deficit, of that increase in the debt over just the last 6 months of 2018. So
and look, the president just made a deal with the Democrats. I don't know if it's going to go through, but a $2 trillion infrastructure spending bill.
Yeah.
So, I mean, where's that money going to come from?
And how much of that money is actually going to be put to good use? I mean, are they already forgetting Obama laughing about the last $1 trillion stimulus bill that we thought, things weren't quite as shovel ready as we thought? How much of that money is actually going to be put to good use?
Money that's spent by the government is never put to good use. I mean, if you want money put to good use, leave it in the private sector where it will be efficiently utilized. But government is not about efficient utilization of resources. And people forget, if the U.S. government is going to spend $1 trillion, the money doesn't come from heaven. Right? So whatever resources the government is going to commandeer from the private sector so that it can spend them comes at the expense of what the private sector might otherwise have done with those resources had the government not taken them. And so whenever government spends money, it's not stimulating the economy, it is sedating the economy.
Great way to put it. We're talking now about how the Fed can never really normalize interest rates, or not to what are historically normal interest rates, because the debt service costs would crater the federal budget. But what if the Fed loses control of interest rates? What if the market out there says we demand much higher rates of return if we're going to put money into the federal coffers? Can the Fed fight that? Can they, in this new day and age, just create and just buy so much of the federal debt themselves?
Well, Brian, it's not a question of if it happens. It's only a question of when it happens. I mean, it is a foregone conclusion that this is going to happen. It's just that a lot of people don't think it's going to happen for a long time, and so they're not worried about it. But, things have a tendency of surprising people and catching them when they're ill prepared for it. But once the jig is up on this, then that's the end of it. I mean, because the government can't bail out itself. The reason the government was able to bail out the banks is because people were willing to accept dollars and treasuries. And so the Fed's credit was still good. It was able to bail everybody out. We were able to move the debt off the balance sheets of some of the banks onto the balance sheets of the Fed. But when people don't want the Fed's IOUs, when they don't want dollars, when they don't want treasury bonds, well, then the bailouts are over. There's nothing they could do. And this is where we're headed. I mean, we're headed for a runaway inflation, a currency crisis, a dollar crisis, because that's the only thing that's going to put an end to it. I mean, it's not like we're going to get fiscally responsible on our own. It's not like we're going to say, we have to defuse this bomb before it blows. What politicians want to do is say, look, how do we make sure that it doesn't blow up until after the next election? So we're assured that the bomb explodes, because the only thing we're trying to do is postpone the blast. We're not trying to diffuse it. Nobody wants to do that, because the act of doing that is going to be unpopular. It's going to create some short-term pain, and politics is not about short-term pain. It's about preventing short-term pain, even if it means excruciating long-term pain, because that's the other guy's problem.
Every month, for nearly 50 years, Gold Newsletter has unearthed high-potential investment opportunities in metals and mining stocks that mainstream investors didn't even know existed. The value and profit potential we pack into each and every issue of Gold Newsletter make it an absolute steal at just $198 per year. Your subscription includes 2 special reports, Money Multipliers, resource stocks poised to triple, and The Investor's Guide to Gold and Silver. To subscribe, visit www.goldnewsletter.com and click subscribe now to discover how to multiply your returns in today's gold bull market.
Well, how will the popping of this bubble? I mean, you've said, and you're not alone in this, that the bubble at this time is much greater or more severe than before. How will that manifest itself differently once it begins?
Well, again, the last 2 big bubbles, when they popped and investors lost money, they were bailed out. I mean, if you wrote out the entire thing. I mean, you saw the market got cut in half in 2000, 2001. The NASDAQ went down by 80%. But, if you wrote it out, the market's made new highs. The market got cut in half again in 2008. But if you wrote it out, the market's made new highs. And the reason for that was the Fed. The Fed inflated the dot-com bubble. But after it popped, they were able to successfully inflate a bigger bubble. And when the housing bubble popped, they successfully inflated the bubble we have now, which is bigger than those two combined. So the question is, do you think the Fed will be able to do it again? Is it going to be possible that this bubble pops and then they're able to make an even bigger one? Because you always need a bigger one than the one before to get it going. And we have to go deeper into debt. That's the key. We have to be able to go deeper and deeper into debt to keep on spending money we don't have. Well, I just don't think that's possible because the numbers are just so enormous at this stage that I just don't see how we can do it. I mean, I'm surprised we did it last time, but the fact, for us to be able to do it again, and as I said earlier in this interview, what made it possible, remember, gold initially went up to $1,900. I'm sure, Brian, you remember that after the Fed did QE1, because there was a lot of concern, and rightfully so, that this was banana republic monetary policy, that the Fed was monetizing the debt. But ultimately, the markets were fooled into believing that that wasn't the case, that it was just a temporary emergency measure, that it can easily be unwound, that it was successful and everything was fine. And so the fear went away and people sold gold and they bought dollars and the stock market rally went on. But when this happens again, nobody is going to be dumb enough to believe that this isn't permanent. I mean, when the Fed has a $10 trillion balance sheet or greater, everybody's going to know there's no way the Fed is ever going to sell those bonds. It'll be impossible. So this is a permanent monetization. And as the government gets bigger and bigger and the debts get bigger and bigger, people will realize that they are never going to get repaid. So either they're going to be defaulted on or they're going to be inflated away, which is really the same thing, just a different means. But that's going to be it. And we're going to finally have a day of reckoning. The dollar is going to tank, and then we're going to have a very difficult decision. Doing the right thing at that point is going to be extremely painful, and doing the wrong thing is going to be even more painful. It just may take a little bit longer, but it's not going to be a big delay, because I think the markets are going to sniff this out, and things are going to unravel very, very quickly. I mean, we've seen that. I mean, we've seen how much the stock market can go down in one day on basically nothing. I mean, we've seen the Dow drop. I mean, imagine if we actually had something really bad that happened,
I think if there's any place where we have a disagreement, and it's not really a disagreement, but I'm not sure that this next boom bubble burst and reflation cycle will be the one where the dollar loses all credibility, because all these other currencies are in the same boat. All these other economies in the same boat. They've created the same levels of debt. They're all trying to deflate as well. But I guess your view is that the U.S. dollar, as the world's reserve currency, is set to lose that coveted role, and that's where it's going to lose credibility.
Yeah. Well, I've heard, the idea that, hey, everything's going to hit the fan and everybody's going to rush into the dollar, because that's what they did in 2008. And so people just look back to 2008 as if that's the playbook. And so they expect that if there's another crisis, that everybody's going to buy the dollar again like they did back then. And I don't think so, because first of all, if you remember, in 2008, the dollar was at an all-time record low. Gold was at an all-time record high. So people had been betting against the dollar for years, and everybody was crowded into the short dollar trade. And so when they got surprised by the events of '08, a lot of people were looking for liquidity, and so they had to cover up those bets. Gold was at an all-time record high. At the time, gold was at 1,000 in the summer of 2008. It had never been there, and it had been going up for years. And so everybody was loaded up with gold. And so then when the financial crisis hit, people sold gold. But today, gold has been falling for years. The dollar is at the highs. Everybody is bullish on the dollar. And so I think it's very different. People are fighting the last war but this war is not going to look like that war. It's going to look different. And also, the last time...
gold's the piggy bank that gets broken up in times of distress and when the traders need liquidity to meet margin calls. But like you say, they don't own, gold is not widely owned by those same people today, and the dollar is at fairly high levels.
And the other problem was, the last time around, the problem was that mortgages, toxic mortgages that were defaulting, were owned by financial institutions all over the world. And as these things were collapsing, this was causing a problem internationally. That's not going to happen this time. This time, it's just going to be about the dollar going down. It's going to be about, U.S. dollars losing value. So it's a totally different story than what we had in 2008. And it's, and if it's a treasury crisis, it's not going to be about the treasury bonds defaulting. I mean, people are just going to be able to sell them. There'll be a market. It's going to be about the dollar losing its value. So, and that's the other thing, because it was the strength of the dollar that really compounded the problem for overseas markets. I think when the dollar falls, that's really going to alleviate the problems. Right now, the big problem facing a lot of the world's economies, particularly emerging markets, have been the strengthening dollar and the belief that the dollar would keep on strengthening. But once that threat is removed, then I think that's going to provide big support for the global economy while the U.S. economy is suffering.
We started off, Ferguson mentioned at the beginning of this episode that the booms, bubbles, and busts panel that you served on with Mike Larson, and more notably for you with Ben Hunt, who is, I think, shares our skepticism on the current markets and the narrative in the current markets and the Fed's role, et cetera, but really disagreed with you as far as what the prescription will be from an investor's standpoint, what an investor can do to protect themselves and or profit. Ben is more, I guess, of a mainstream investor and doesn't really consider gold as a credible asset class or a real alternative for investors. And I'm not really sure, watching the panel, what he did recommend. He really kind of recommended just buying things like, I guess, income-producing real estate close to home, things et cetera, but really didn't think gold or emerging markets, which I think you view as another safer haven, at least, or profit opportunity for investors.
Yeah, I wouldn't describe emerging markets as a safe haven. I think they are, an opportunity to profit. But I think if you don't, appreciate the value that gold provides, I mean, you probably have minimal understanding. I mean, gold is about liquidity. Gold is not an alternative to stocks or real estate or bonds. Gold is an alternative to dollars or euros or yen, right? Gold is money, and currencies are money substitutes. But for many, many years, people have preferred money substitutes because of the positive carry, right? If you own a currency, you can earn interest on the currency. If you own gold, you typically don't. I mean, it doesn't mean that you can't have a gold loan, but in general, most people that own gold are not loaning it out. But most people who own dollars are loaning them out. I mean, if you don't loan out your dollars, you get zero return on dollars. I mean, if you take dollars and stuff them in your mattress, you don't earn any interest. But if you put dollars in a bank, or if you use your dollars to buy bonds, you have a positive interest. Except now you have so many bonds that have negative interest. And if you deposit your money in the bank, you really don't make any interest on the money. And so that just makes gold look that much more appealing as an alternative, especially now, when you hear the central bankers all around the world, they all say that we need to have 2% inflation. What they're really saying is that the value of money needs to decline by 2% a year. Now, this is new when it comes to central banking, because prior to that, the goal of central bankers was for money to maintain its value. Now, they failed miserably. I mean, their paper currency lost a lot of value, but at least they were striving to maintain the value. They wanted price stability. They didn't want the currency to lose any value. Well, now they wanted to lose value. So if it lost so much value when they wanted to keep it stable, imagine how much value it's going to lose now when that's their stated goal. So if you have a choice between owning dollars, right, or another currency where the central bank has told you, we will try to make sure that those dollars lose value every year, and more than interest. If they're saying we want the dollar to lose 2% of its value every year, and you can't get 2% interest on the dollar, well, you're a guaranteed loser. So if your choice is between a guaranteed loss in a fiat currency or stability with gold, I mean, it's a no-brainer that people are going to want to use gold, own gold, instead of fiat currencies. Now, of course, you've got a group of people now that say no. People are going to want to own Bitcoin, right, or some other cryptocurrency. In fact, this guy that I'm debating, this guy Barry Siebert, I think is his name, at the Greystoke Gold Trust, or that he owns. I'm doing a debate with him in about a week in Las Vegas at this Skybridge Alternative Asset Conference, a gold versus Bitcoin. But this guy just launched a new website called Drop Gold, and he actually shot these commercials that he's going to start running on television, urging people to drop their gold, right, sell their gold, and buy Bitcoin. Because gold is for fools, gold is outdated, it's the horse and buggy, and Bitcoin is the automobile. Bitcoin is the future. It's the gold, and that people that are holding gold are fools. They should sell it and buy Bitcoin.
Yeah, this time is different. How many times have we heard that?
Yeah, and the funny thing, he claims, unlike gold, Bitcoin actually has utility. Like gold is just this useless relic. It has no utility whatsoever. You can't do anything with gold, but Bitcoin has so much value.
Well, one of the things you were kind of alluding to is that the Fed now is trying to raise inflation, trying to boost inflation. At the same time, they're in a trick box where they can never normalize interest rates again. So we're never going to have, if the Fed remains in control, normal interest rates are always going to be at the end of the spectrum.
Yeah, well, they try to redefine what normal is, just like, the Fed has now redefined price stability because their goal is still price stability. They've just defined it as prices that go up every year by 2%. And somehow that's the new definition of stability. So this is the new normal, right? Whatever interest rates are is now normal.
Low real rates, right? And what's the strongest correlation of gold prices is real interest rates.
Well, real interest rates are never going to be positive again until there's a crisis, because the minute they go positive, there'll be a crisis. So they have to keep interest rates low because that's the only way to keep the debtors afloat. That's the only way that this Ponzi scheme can stay going. But but eventually the debt is so big that even a very low rate of interest is still more than you can afford to pay. But people miss the big picture, how much damage is being done to the economy by keeping interest rates artificially low. Sure, you can preserve the bubbles and you can enable the growth of government, but all that comes at the expense of the real economy. This is not something for nothing. So by keeping interest rates artificially low, you discourage savings, which means you discourage real capital investment, real growing productivity. That's the reason there's no productivity growth. That's the reason that we're not seeing, real incomes rising. That's the reason we're seeing this widening gap between the very rich and everybody else. It's not a new normal. It's the normal that the Federal Reserve has created with this monetary policy and all the misallocations and distortions that are the consequences of this government price fixing. I mean, we all know that if the government were to fix the price of anything, that it's going to create distortions in the market and it's going to create problems. I mean, and it's no different if you're going to fix the price of interest. I mean, interest rates should be discovered in the market like any other price. The supply is the savings that we all have, and the demand is businesses and consumers and governments that want to borrow from this supply of savings. And you have to find an interest rate that clears the market. But we don't have that. We have an artificially low interest rate, and so this is doing incredible damage to the structure of the economy, and it's going to result in a complete catastrophe. I mean, it's already resulted in a lower standard of living for everybody. I mean, not everybody, but most of the people. But the crisis has thus far been averted, but it hasn't been called off. It's just been delayed.
Yeah, and on that note, people always want to know what's the timing, when's it going to happen, and I tell people to focus less on the timing and more on the inevitability. Just make sure that you're positioned in gold, and that from a speculative standpoint, you have some leverage to it as well through equities, et cetera.
Yeah, look, I mean, I wish I knew when. I mean, obviously, I was warning about this stuff a decade ago, and we got the financial crisis, which was the first part of my warning. I mean, I believed at the time that I was forecasting the financial crisis. At the time, I believed that the housing bubble was so big and that the damage it would do to the economy when it popped was so big that that was going to set off the dollar crisis. I thought that when the Fed slashed interest rates and printed a bunch of money to try to reflate the housing bubble, that the markets would get wise at that point and the dollar would sell off and gold would take off. And it almost happened, but then it didn't happen. And then what surprised me was that the Fed didn't just attempt to reflate the bubbles, it succeeded and it made it even bigger. And so I didn't think that that was going to happen. But just because it happened then, it doesn't mean it's going to happen again, because the numbers are now off the charts impossible. So if you want to bet on that, if you want to bet on the Fed's ability to blow an even bigger bubble than this one, go ahead. I think that's a fool's bet. I'd rather bet against the Fed this time. I'd rather bet that it's not the third time's the charm, right? That it's 3 strikes and they're out.
Right. Well, we've raced through the half hour, Peter. So
right.
If people want to learn more about his work, organizations, the 3 we'll mention are Euro-Pacific Capital, that's Europac.com, Schiff Gold, which is schiffgold.com, and then he has his own show, The Peter Schiff Show, which is schiffradio.com. And he's also going to be a speaker at the New Orleans Conference. That's neworleansconference.com. And use that code SCHIFF, SCHIFF, to get an upgrade to your attendance there. So, Peter, obviously we're looking forward to it. I hope we have a panel like last time. Brian will maybe confirm or deny that. But it was, I appreciate your time.
We have Peter on a very lively panel. You can bet on that.
Great. Thanks so much, Peter.
All right, just give me a good keynote spot.
You got it.
And a good workshop.
Cheers.
Not the last one of the last hour of the last day.
We have to be careful with you, Peter. You're such a big draw. But I think we've got a good one for you this year.
All right.
Thanks
Bye.
so much.
Beauty. Bye-bye.